We ran the event study on 1,968 forward stock splits on U.S. exchanges from 2000 to 2025. The pre-split window is real, 1.31% in 5 days. But the post-split drift has disappeared. In aggregate, split stocks perform roughly in line with SPY, the S&P 500 ETF. The real story is in the ratio. 2-for-1 splits still work, but 5-for-1 and above lose 11.67% versus the market over 1 year. This is an event study measuring cumulative abnormal returns around forward stock splits. We detect every split where the numerator exceeds the denominator, filter to U.S. exchanges and market cap above $500 million, and track returns using adjusted close prices. The adjusted close already accounts for the split retroactively, so our return calculations are clean. Without that adjustment, a 4-for-1 split would look like a 75% price drop in the raw data. We use mark-on-close execution. Post-event returns are measured from the next trading day's close. We measure at 6 windows, 5 days before the effective date, then 5 days, 1 month, 3 months, 6 months, and 1 year after. The wider post-event windows are necessary because the split effect, whether positive or negative, unfolds more slowly than earnings drift. Eikenberry, Rankin, and Stice measured through 36 months in their 1996 study. We go to roughly 1 year. That captures the bulk of the documented effect without stretching so far that noise overwhelms signal. Events are stratified by split ratio: 2-for-1, 3-for-1, 4-for-1, 5-for-1, and above, and other fractional ratios. Fama, Fisher, Jensen, and Roll first studied stock splits in 1969 in one of the earliest event studies in finance. They found the market adjusts sufficiently around split announcements. Eikenberry, Rankin, and Stice documented 7.9% first-year abnormal returns for split stocks in 1996, arguing that splits signal management confidence about future earnings. The hypothesis: companies split when they believe the stock will continue rising, and the market underreacts to this signal. 3 mechanisms were proposed. Retail attention: a lower price attracts new buyers who are priced out. Liquidity improvement: more shares outstanding tighten bid-ask spreads. Institutional rebalancing: some funds have share price rules, so splits create new eligible buyers. All 3 predict positive drift after the split date. We're testing whether that pattern survives in 2000 to 2025 data. Markets have changed substantially. Information travels faster. Retail participation is higher and more reactive. Algorithmic trading has compressed the window for price discovery. The gradual information diffusion that produced post-split drift in the 1990s may not exist in today's markets. The full dataset: 1,968 forward splits on U.S. exchanges, 1,918 with complete 1-year price data. The 5 days before the split are the only statistically significant window. Stocks gain 1.31% versus SPY, the S&P 500 ETF, with a t-statistic of 3.81 as retail attention peaks around the event. After the split, the aggregate drift is essentially zero. At 5 days, negative 0.25%. At 1 month, negative 0.42%. At 3 months, negative 0.42%. At 3 months, negative 0.64%. None of these are statistically significant. By 6 months, it flips to positive 0.38%, and at 1 year, it's positive 0.58%. The post-split drift documented by Eikenberry in 1996 hasn't reversed into a negative. It has simply disappeared. The aggregate effect is indistinguishable from noise. The median tells a slightly different story. At 1 year, the median CAR is negative 1.00%, while the mean is positive 0.58%. A few big winners pull the average up, but the typical split stock slightly trails SPY. At 3 months, 48.0% of split stocks beat SPY. That's roughly a coin flip. The stratification by ratio is where the real story emerges. The pattern delivers the opposite of what signaling theory predicts for extreme ratios. Standard 2-for-1 splits show positive 2.58% at 1 year, statistically significant, but 4-for-1 splits lose 8.35%, and 5-for-1 and above lose 11.67%, both highly significant. Only 31.3% of extreme ratio splits beat SPY over 1 year. Extreme split ratios mark periods of peak retail attention. NVIDIA's 10-for-1 split in June 2024 after a 730% run made shares accessible to retail at what turned out to be a local peak. That's not a confidence signal. That's management responding to a momentum high. The pre-split window is the only statistically significant period in aggregate. The 5 days before the effective date show 1.31% with a t-statistic of 3.81. But capturing it requires monitoring split announcements, not effective dates, because the market starts pricing the event at announcement. Post-split, the aggregate signal is gone. Hit rates hover near 48% to 49% at every window, barely different from random. But the ratio breakdown changes the picture. Standard 2-for-1 splits, the most common type, show a significant positive 2.58% at 1 year. If you're buying split stocks, stick to 2-for-1. Extreme ratio splits, 5-for-1 and above, are the ones to avoid. Their 31.3% hit rate at 1 year means roughly 7 out of 10 trail SPY. Forward splits have become rarer over the past 2 decades. Companies routinely split to keep share prices in the $20 to $80 range through the early 2000s. That convention has faded. Many now let prices run into the hundreds or thousands. The 2021 to 2025 period had 167 splits at 3-for-1 or higher among 500 million or more companies. The largest share of extreme ratios in any 5-year window, 51%. The splits that do happen tend to be high-ratio events from momentum names, exactly the category that underperforms most. The composition has shifted too. Today splits come disproportionately from tech and momentum stocks at extreme ratios, not the mature industrials and banks that dominated the 2000 sample. The signal is different because the population is different. The 3-for-1 category is interesting. At 1 year, it shows positive 1.01%, not significant. But at 3 months, T plus 63, it drops to negative 2.85%, with a t-statistic of negative 2.53, statistically significant. There's a dip then recovery pattern for 3-for-1 splits that doesn't appear in other categories. The momentum confound is the biggest caveat. Companies split after strong price appreciation. Part of the post-split underperformance may be mean reversion from a momentum run-up, not a split-specific effect. Our SPY benchmark controls for broad market moves, but not for company-specific momentum. A momentum-adjusted benchmark would isolate the split effect more cleanly, but that's a study for another day. Our data uses the effective split date, not the announcement date. The market begins pricing the split at announcement, which can be weeks earlier. Some of the pre-split return captures post-announcement drift rather than pure anticipation ahead of the effective date. An ideal study would measure from announcement day, but most data providers don't track split announcement dates separately. Survivorship bias is a factor. Our data provider includes delisted stocks, which mitigates it. But companies that split and later decline to penny stock status may have incomplete price histories. Transaction costs aren't included. The pre-split long signal requires monitoring announcements and executing within a narrow window. The post-split short signal has practical challenges: hard to borrow shares, retail sentiment working against the short position, and the risk of being wrong on the handful of splits that do keep compounding. That's what the data shows across 1,968 events and 25 years. Full results, charts, and the analysis code are on the blog. The post-split anomaly from 1996 has disappeared in aggregate. The ratio is the signal. 2-for-1 splits still show modest outperformance, while extreme ratio splits significantly underperform. If you want to screen for upcoming splits yourself, the query is live on cetaresearch.com. All links are in the description. Subscribe for more backtested strategies every week.